what I did do yesterday, I'll tell you. My last wall in the pool room, I put up that stone yesterday. Water's going in the pool.
Well, the Taj Mahal is coming to completion. Are they still mistaking it as a rec center in that neighborhood?
Hello and welcome, ladies and gentlemen, to episode 25 of Rein It In. And we got 3 sticky notes today, not 4, not 2, but 3 sticky notes. We're going to cover market statistics, how the prices are doing, how the rents are doing, how the market is changing right before your very eyes. Then we're also going to look at the regionality. That's the second sticky note, is the regionality of the market. And we're going to look at DI Vault to show you this with some new AI technology that's going to blow you away. And the third and final sticky note, Patrick, is the turmoil that's happening in the short-term real estate market. It's getting pretty hairy out there, and we're going to be talking about it. So strap in, get ready. It's going to be a great episode.
Hey, folks, just a quick reminder always to like, subscribe, share, throw it in the comments. What do you like? Hey, listen, we've been getting some good comments, by the way, JG, so positive. Anyways, like, subscribe, share, hit the bell for notifications. See you on the other side.
All right, Patrick, let's start with the first kind of sticky note here on market statistics. There's actually quite a bit happening because the month is kind of reset here. We're starting to get some data for August. We're starting to get some data for September. By the way, folks, if you don't like having to wait so long to get data, I'm going to show you how you can get instant, up-to-the-minute data at your fingertips in real time. I'll show you that in a little bit, though. But Patrick, what's happening right now is home resales is really where we're going to start. Home resales fell 1.9% month over month nationwide. You and I are not big fans of nationwide, but this is what the Bank of Canada looks at. And in fact, that's where this is going, because after we cover a bit of market statistics here, Patrick, I'm going to ask you to make a prediction.
You sure about that? You sure about that? You sure about that?
Another prediction on what the Bank of Canada is going to do next week, because we're going to get another rate announcement.
Well, I think we need to, really dial a couple things in. First and foremost, the Bank of Canada makes decisions based on really 2 markets. Like if they're weighting those markets, Toronto, Vancouver are going to be weighted heavy in terms of whatever decision making that they're going through. And so those are the biggest parts of our population. That's where the markets are. This national kind of housing statistic that they're always showing is based primarily on those 2 markets, a little bit of course, what's happening in Montreal. But I think we have to really, point this out. And it's hard to be critical of the talking heads, JG, but if I hear one more, because we're talking heads technically, right? But if I hear one more person on TikTok, YouTube, Instagram, whatever it might be, with their agenda, lots of realtors, lots of brokers, talking about this housing bubble, I'm going to lose my mind. Because they're actually now comparing the most recent one, who has a very significant following. I literally wanted to reach out to him and choke him. Dude, quit saying and comparing Toronto to Calgary. He's literally saying Toronto's in a bubble and Calgary's not far behind. It just is driving me crazy. And he's making it all about housing prices. Like there's no data supporting it. There's not about economic fundamentals. It's about market sentiment, and it's about how the world's coming to an end in the housing market. It just makes me nuts. There's nothing to support it. That's my little rant right now. Sorry.
I call them Twexperts. Twexperts,
yes.
Twitter experts, yeah. Twexperts. I introduced that term on the last episode. Are you referring to Twexperts, Patrick? Twexperts?
Exactly. That's exactly what I'm referring to. But as soon as somebody compares Toronto to Calgary, I go, you have no clue what you're talking about. Like they're totally different markets.
Yeah, what they're trying to do is sell real estate. So, that's usually the agenda that's behind it. But let's look at some real data, Patrick, in terms of what's happening right now. We are going to show the regionality of this market here in just a second. But before, let's cover kind of some national statistics. So nationally, home resales fell 1.9% month over month. And this is the 3rd consecutive month decline. So you can see that in this chart here. And that's really across Canada has thrown the market into what across the country we're calling a balanced market. That's how that's the sales to new listings ratio is now at 0.51, which makes it smack dab in the middle of a balanced market. Now, Patrick, you and I drives us crazy. because you got to look at the regionality of these markets, because the entire country is not in a balanced market. Some are in a buyer's market. In fact, a lot of markets are in a buyer's market, and I'm going to show you that in just a second. But this is what's going on nationally, Patrick. And definitely you can see we had spiked up into a seller's market. We're back down into a balanced market. The what's the word, no, I don't know, that's a French word. I was trying to make up a French word there. It's not working for me, so let's just keep going.
But I think there's something to note about a national number. I mean, this goes back to 2000 or whatever it is. And, if you're comparing apples to apples, you look at this market and you go, okay, nationally, this is what's happening. So we just happen to know that. So if you're looking at it just as a comparative over this number of years, you go, okay, we're back where we were. You see the spike that happened in, through the pandemic and the results of that. So you are comparing apples to apples on a national level. We just know what makes up that national stat. And so that's what we have to be aware of. It's primarily going to be driven by Toronto, even Toronto GTA, and then Vancouver.
Just to recap, home resales, which is the volume, is down 1.9%. Across Canada, we're looking at a balanced market, pretty much smack dab in the middle of that. And then the MLS home price index is up 1.1% across Canada. Now, this is a perfect example, Patrick, of how some people get misguided by these headlines, because it's very different what's happening in different markets. Some prices, and we'll show you in just a second with the DI Vault, how we have this new AI technology that you could actually see what's happening in each individual market instead of relying on this kind of national weather report, if you will, this national house price report, which makes no sense as a real estate investor.
Yeah, you're going to have to keep breaking down the markets. We seem to be kind of saying that to nauseum, but it's such an important, and people still get caught in the headlines of what's happening nationally. I think we have to pay attention to it. I think at the end of the day as well, even if you look at this chart, JG, it goes back to 2000, and are real estate prices off their highs? 100%. You look at it and it's pretty obvious. And then we know that, in fact, when you look at those larger markets where there was a lot of transactions happening, especially in that condo market, which was really where a lot of volume was happening, there just wasn't. And I mean, yes, a lot of detached sold as well. But let's put it this way, you look at the peak, and are we off of the peak? 100%. But it's not like the bottom's fallen out of the market. If you want to compare apples to apples using this chart, you go, no, it's not that bad.
So let's have a peek. Let's dive into DI Vault here, and you can have a see here, folks. Anything that is red, this is the 30-day price change. Anything that's red means the prices have been lowering in the last 30 days. Anything that's green means they've been increasing. Anything that's yellow, they've been neutral. Okay. Now, here's what's, Patrick, you and I talk about regionality all the time, but here's what's fascinating. When you look at a chart like this, if I just zoomed into Oshawa a little bit here, I love it how you can see it on the east side of Oshawa as you approach Bowmanville. In the last 30 days, prices have been going down. But central Oshawa, prices have been going up in the last 30 days. I mean, literally, these are neighboring markets, Patrick, that are divided by streets. Like, we're talking about one street apart, and that's the difference. So when you look at an overarching report like Canada's house prices are up 1.1% or down 5% or whatever the case may be, it's so misleading for real estate investors. And this is what's been happening in the last 30 days. And I'll show you, we have up to the minute what's been happening in the last 90 days. And you could see that the market changes. It looks at the trend for the last 90 days, and regions that were red are now could still be green in this case, because we got to look at what's been happening over 90 days and 30 days to get an accurate picture of the actual region that you're investing in. And Patrick, this is what a sophisticated investor needs: access to tools like this, specifically this one, folks, DI Vault. You got to get in on this tool, because the technology makes it so easy for you to know exactly where the market is instead of guessing based on headlines, Patrick.
Well, you make such a great point. I think when you look at real estate investing in Canada, I mean, that's a program that we've taught for 30 years. The Real Estate Investment Network, Real Estate Investing in Canada, it's a system, it's a process. We've shared thousands of times about the regionality right down to the neighborhood. What this technology has opened up the opportunity for us is to get really granular and make it far easier. Yes, we always did the research, but it was like really manual research, relatively speaking. So when you take real estate investing in Canada, learning how to invest in real estate the right way, marry it to the technology that gives you the data that you need to make decisions. I mean, this, from my point of view, technology is the game changer for investors and where and how you grow a portfolio in the future.
So that really covers market stats here, Patrick. And I think it's important that now that we've really analyzed that regionality, I think we should switch gears into rents, because there's some new headlines that have come out in terms of rents and what rents are doing. And I'm going to put some charts here on the screen where rents have been trending upwards for quite some time, and we're starting to see that trend is changing. But again, these are national numbers. These are GTA numbers. These are Vancouver numbers or Greater Vancouver area numbers. The point is that these massive regions, and the country is the biggest region, really mislead a lot of real estate investors in terms of what's actually happening with rents. And we could solve this issue with the DI Vault, and we have solved this issue with the DI Vault. But tell us what the macro charts is showing across the country, Patrick.
Well, when we look at rents, first and foremost, when they show these charts and when they make these headlines, investors aside, this is what creates controversy with tenants and the negativity around rental housing providers. They're getting rich. They're just raising rents. It's like there's no method to the madness. They just keep taking advantage of us. So this is all part of that game. It seems that, and of course it plays perfectly into the politicians, because they don't have to take responsibility for the mess they've created in the housing market, in immigration. They have to take no responsibility for it. They can blame us. So when they show these charts and they show, look how much rents have come up. It's true, by the way, but let's face it, there's a reality in behind that says, interest rates have gone up. The cost of actually doing business as a rental housing provider has gone up. Insurance has gone up. Let's face it. But these headlines really drive the controversy, if you will. And this is what the government will do, and federal, municipal, provincial. This is where politics over policy comes into play. Long story, but that's part of it. Now, having said all of that, rents have come up. And if you look at the rents overall, and you basically break it down again by province, even by municipality, you see that most of them have bumped up against that ceiling. It's like, okay, we've hit the ceiling of limitation of what people are willing to pay.
I've never really liked paying bills.
Having said that, rental demand is going nowhere anytime soon. People are going to continue to rent. And if anything, aside from the immigration, JG, affordability and the ability to get a mortgage, have a down payment, get that financing has shifted many people who would be first-time buyers to the sidelines. They either can't buy or they're afraid to buy, and they want to wait for the market to crash because we're in a bubble. So what does that mean for us as rental housing providers? We're going to have a steady stream of demand for our units.
Now let's flip over to DI Vault, folks, so we can show you exactly how this changes when you look at region by region and you look at the individual rents. And by the way, if you're asking yourself, how do I get involved in DI Vault? How do I get this platform? How do I join? Go to di-vault.com and you will be able to actually get to one of our info sessions so we can show you how to use the platform. So check that out, di-vault.com. But if I click on this layer here of rent change, look what happens. Look at this. This is fascinating, Patrick. Here we have this sweeping statement saying rents are going up. Rents are going up everywhere. No, they're not. Look at this actual chart where you can see the green regions. Rents have gone up. By the way, in the last 30 days, rents have gone up in the last 30 days. The red areas are where prices have gone down in the last 30 days, and there are plenty of them. And the yellow areas are places that have been stable for the last 30 days in terms of rents. Now, one of my favorite tools of DI Vault is another layer called the upside rent potential. This, Patrick, uses AI technology as well as machine learning to predict where rents are going in the next 30, 60, 90 days. And check this out. If I click on that layer, you can see certain markets. Look, certain markets are red, which means they do expect that rents are going to be going down in the next 30, 60, 90 days. Now, let me just clarify something. Does that mean it's because it's a bad rental market? Absolutely not. The reason this is happening is because those markets are just happen to be at the peak of where they can be for rents for now. And if I look at Peterborough right now, Patrick, you can see that it's red, which means in the next 30, 60, 90 days, we expect rents to come down a little bit. And I'm actually seeing that in the market right here, right now. And the reason is because we've had a big run up in the last 60, 90 days. Rents have shot up quite significantly here. So now we're just taking a pause. We're just taking a breath. things are going to level off, things are going to cool off a little bit, and that's okay. There's nothing wrong with that. What's important as a real estate investor is to know what's going to happen and to be prepared for it, Patrick. But with tools like this, you don't have to rely on stupid headlines that make statements that are irrelevant to real estate investors. You can actually look at your actual market to see what's actually happening and then make business decisions based on that.
Yeah, and or listen to talking heads who are trying to make the Toronto market relate to the Calgary market. Anyways, I'll get over that. But something that we need to clarify here too, JG, is that the red shows that rents have come down a little bit. But again, it's not like this epic crash of rents. They're not coming down several $100s a month. The detail that the technology picks up on is going to be, maybe $50, maybe $100. The point is that rents have come off a little bit in that particular area. And I think at some point, we have to really speak to what's going on economically on a global macro scale, JG. And I don't know if this is the right time to insert this, but I think we need to shine a light on the, potentially the impending, world war, if you want to go that dark. But listen, there's a lot of things that are happening now, given what's, with what's happening with Hamas and Israel. And, we then look at, all of a sudden, Ukraine and Russia is off the map in terms of conversation. But there's a lot of global macro issues happening that is going to impact us. JG, I told you, and I've said it many times, I think oil prices now with this happening are going to go through the freaking roof. So what does that mean for us? When it comes to the cost of living, when it comes to the rate of inflation, as oil goes up, so will inflation. I think we're at a huge risk there of seeing big inflation. Again, what does that mean for us as investors? It means that we're going to see some rising costs. We're also going to have rising rents because of affordability and the inflation and the discretionary income that people are lacking to buy a piece of real estate. So kind of trying to condense it all, but I think it's a good point to insert here.
Yeah, for sure. And what's interesting as a real estate investor, for those of you listening, is you have to look at, number one, go look at the data, go look at what's actually happening in your market, and then make some decisions. Patrick, I think you said it really well, which is we don't expect rental demand, for it to fall off the map anytime soon because of so much immigration coming into the country. And we expect that's going to continue. That being said, I can tell you firsthand, I'm experiencing this where people are definitely more reluctant to move. People are just like burying the hatchets down right now. They're thinking, you know what, I'm just going to stay where I am. I'll look at moving in a year or in 2 years. I'm good. I'm okay.
And I am telling you, I'm not going.
The moves we saw during COVID where people were moving out of town, where people were really pushing to move and they wanted a better space. We're kind of getting almost the opposite of that right now, Patrick, where people are just saying, listen, there's enough uncertainty in this world right now. I'm just going to wait and I'm just going to see how it goes. I'll reassess this in 6 months or 12 months. And we're seeing a lot of renters that are very interested in, listen, just let's just renew the lease. We're just going to stay where we are. We're okay with that. And that's fantastic. That's also stable. That's stability for us real estate investors. I don't think it's necessarily a bad thing, especially when you couple that with a lot of incoming rental demand. I think it's good, and prices eventually will continue to rise on rents. And of course, we all want them to rise more to keep up with the crazy interest rates that a lot of people are having to tackle with. But the point remains that you have a lot of demand for rentals, and that's a great thing for us real estate investors.
100%. And JG, let's just say it again so that we are on record. We're not suggesting to investors to just throw money into the real estate market, and see what sticks. This is being strategic. It is being thoughtful. It is being really clear on what the strategies and tactics you're going to use. Buying for cash flow, understanding that there's lots of deals out there. You don't need to rush into anything, and then tapping into technology like DI Vault to find those deals to make sure that you're buying in the right market in terms of rental demand. I mean, these are all things that we bring together. I think the big thing here is that many rental housing providers don't have the experience. They don't have the technology. They want it to be easier. And listen, this makes it far, far easier, but you go through it to create that long-term kind of future financial success. You go through this process. And right now, in all the chaos, when everybody's running for the hills, it's those that kind of keep grinding it out that are going to do exceptionally well.
Folks, check out di-vault.com. Come to one of those info sessions. Get involved in this technology. You'll be blown away by how it's going to save you a ton of time. Things that used to take you weeks or months to do, you can now do in minutes thanks to AI, thanks to machine learning, thanks to predictive analytics, thanks to all of this technology. It's there to help you. It's there to serve you. So check that out, di-vault.com. And that's a bit of that's our regionality segment of this, as well as we threw in some rents there and to show you how things are changing. So that was a great segment. Thanks, Pat. So the next segment, Patrick, I want to cover before we get to short-term rentals, because there's a ton to talk about short-term rentals. Now that we've covered some market stats, some rents, we've talked a little bit about CPI, and let's bring in that conversation about CPI a little bit more. But I think that, Patrick, it is time for you to make a good old-fashioned Patrick prediction. But what do you think is going to happen? Are they going to raise interest rates next week? What is going to happen?
I mean, never say never. I'd be so surprised if Bank of Canada raises rates. They don't have a reason to at this point. I mean, certainly inflation has come down, 3.8 from 4 point whatever it was, 4.2 or 4.6. I don't remember. So inflation has come back down. What's interesting.
So the numbers are, it's 3.67 from 4.29 is what it's at right now.
So it goes back to what we said several times. The Bank of Canada needs to pause, let all these lags work through the system. And when we look at that 3.67, by the way, over 30% of it is of that CPI number is the interest payment on mortgage. So if you take that out of there, the next thing you know, you're already down to about 3.2%. And if you look at rents and realize that rents are up, a lot of the rents are up because of the cost of actually holding that property by the rental housing provider. I mean, we would be at probably 3%. And so it makes no sense for them to raise it. But, listen, I don't know that the Bank of Canada makes sense. So, and our, finance, Chrystia Freeland, makes even less sense. So I say I'd be shocked if they do, but never say never.
Never say
Got it.
never.
So, and I'm in your camp, Patrick, and I like how you set that up, which is what they should do and what they will do. Well, that's maybe two different things there, but I think everyone's kind of expecting there not to be a rate hike. So far, all the stats have really come out in the direction of pausing, which is great. I definitely, no doubt. I think the entire real estate market is going to be thrilled when there's a rate pause, because everyone's just looking for that stability right now. Patrick, there's a lot of investors with a lot of money in the market, and everyone's on edge, especially with the other socioeconomic issues that are happening in the world. There's definitely a lot of people on edge, and as a result of that, we need some stability. And I'm hoping it comes in the form of interest rate pause. And hey, listen, I'm going to go one step further because I'm a bit of a contrarian, Patrick. Whatever you say, I like to say the opposite. So I'm going to say that they're not going to pause. They're going to cut. That's what I'm saying. That's my JG prediction.
Okay, so I get that's a little tongue-in-cheek, and that would be interesting if they do. I think it's too early, but I will make a bolder prediction, and I think interest rates are going to come down sooner than anticipated. I think a lot of people were anticipating 2024 a little bit of a little bit of a cut. I think those cuts are going to come sooner and even more, given back to what's happening on a global scale. I think they're going to actually throw more liquidity into the system and bring rates down. That's just my view.
Are you ready to put a date on it? Are you saying is a Patrick prediction that they're going to cut rates before the end of the year? Is that what I just heard?
No, not before the end of 2023, but definitely they're going to cut before the middle of 2024. How's that?
First quarter 2024, Patrick prediction, they're going to cut. That's what I just heard.
Okay, sure. I'll take that. I can make that make sense. First quarter, and again, probably in the first half.
First quarter, first half. 2 cuts. I just heard another Patrick prediction. Yeah. 2 cuts in the first half.
I'll be brave. I'm willing to put it out there.
I love it. That's great. Perfect. Well, listen, I'm banking on a cut next week. I hope that would be awesome because I got a property on the
banking
market.
On it. Okay, JG, you're banking on it, really? Okay, I think
Listen, I just put a property on the market today that I need to move, and I got to get a really good price on it because we did a flip, and we've always said, Patrick, doing flips in this kind of market is definitely tough. And this property, luckily, we got a great price on the property, and it left the margin a little thin, so I got to get my price on it, and a rate cut would definitely help me. So I'm going to the bank with a rate cut.
yeah. Well, listen, you're a highly trained professional. I'm sure you'll do fine.
Perfect. Okay, last topic of conversation for today, Patrick, is short-term rentals. The BC government, I should say, British Columbia,
British Columbia, yes.
The BC government has taken a pretty hard line here with short-term rentals, and we have a lot of investors that are freaking out. Now, you and I, Patrick, and I wish I had a timestamp on this because you and I have always told investors to be a little wary and cautious of two types of strategies, which are quite fickle. Yes, they provide better cash flow, but they're fickle. That is the student rental market, and that is the short-term rental market. And when I've been telling investors, don't go change your entire portfolio over to short-term rentals just because you can go get a few extra bucks out of it. And those that listened are happy. Those that did change their entire portfolio over to short-term rental are kind of freaking out right now, Patrick,
This is fine.
because the BC government has taken a hard line. So tell us about that, and then we'll tell you what you can do as an investor if you're being kind of taken by this.
Well, fundamentally, they've made the change that short-term rentals are off the table unless they're in your home. Like literally, you have to be. It's got to be part of your residence. So everything else is off the table, which is going to be problematic for those investors who actually bought units that were very specific to short-term rentals. So in other words, that was their strategy going in. So they're changing the dance step by May 1st, 2024. It has to be shut down. You have to register. There's a whole bunch of little details that you have to embrace. But their goal ultimately is to get long-term rental stock onto the market. What's interesting about that, JG, is it will be, I think, you're going to see some real increases in rents in many BC markets because of that.
Okay, fine. I'm cool. I'm fine.
I think that, if you're not doing a short-term rental and now you've kicked everybody out, you get to reset rents. And if you're going to do a long-term rental, I think you're going to really push the edge of what you can get for rents. So I think there's going to be some downside to this initiative, which is increasing rents as these short-term rentals come onto the long-term rental market.
Patrick, I'm absolutely shocked and flabbergasted that the government made a decision, didn't think it through all the way, and it may have a negative repercussion on the very thing they wanted to impact. I'm surprised by that, Patrick.
I know, it's shocking, isn't it? Unintended consequences. How can that be? So, it is interesting that we talk about this all the time. Government politics over policy. I think this is an example. Let's cut off our nose in spite of our face to make sure that the voters are happy, or the perception of what we're trying to fix. And I don't think they're going to fix anything. I think they've taken too hard a line. And I get it. In certain neighborhoods, it does sometimes make sense to do that. And, Port Coquitlam did that, for example. I think Surrey might have done a segment. Anyways, my point is that they then have to qualify what's happening in those areas where there's a lot of tourism. What do they do with that? And they have to then qualify that. And there are some centers that they're going to make exceptions, but it's all more bureaucracy, more things to do. We'll see how it unfolds. Anytime the provincial government puts an initiative in, I'm skeptical.
I wonder, Patrick, if Marriott and Hilton have any lobbying efforts in this direction. I'm just curious. I mean, I don't know, maybe.
Yeah,
maybe.
Who knows?
So for those of you that have short-term rentals and you're freaking out, by the way, if you're not in BC right now, and if you're thinking, phew, if I just dodged a bullet because I'm in Alberta, or I'm in Saskatchewan, or I'm in Ontario, wherever you are, if you're thinking, phew, if I just dodged a bullet, I'm not in BC. Folks, you don't have to be a genius to look at the trend here of what's been happening. I mean, New York City did it. Toronto did it. Many cities are doing it. And if the cities don't take it on themselves, the provinces are getting involved and doing it. So I think it's a pretty fair statement, Patrick, to say this is going to continue. And is it going to hit every single market? I don't know, but this is definitely something that seems to will continue. So if you're a real estate investor and you have short-term rentals in your portfolio and you're kind of freaking out, here's a couple things that you should be thinking about right now. We'll break it down for you. Number one, you can take a chance and operate on the black market. That is a possibility, Patrick. You and I don't recommend it, but that is a possibility, which is I'm just going to ignore this and I'm just going to operate anyways. It's an option. I don't recommend it, but it's an option.
Well, I think, yeah, you can't we're not going to recommend any of that. I mean, it's a real risk to do that because when these things happen, of course, you're going to have neighbors that are unhappy with the short-term rental and they're living in maybe in the building as a permanent residents of that particular building. Maybe they're an owner or they're a long-term renter. They don't like short-term rentals. They don't like the turnover, the noise, all of the things that go with it sometimes. And so you're really putting yourself at risk in terms of even just being reported. So I don't think, depending on the building, you're not going to get away with it for long.
Option one, operate on the black market, not recommended. Option two, sell the property. That is an option for some people. They might say, you know what, because some people, Patrick, if you just bought this property last year, for example, you bought it at the height, it's currently in a dip, you're thinking, oh man, I can't sell this property. But some people have actually held these properties for a long time. And this may be an opportune time to sell the property, get it vacant, sell the property and cash out on the property. Again, not something that's not recommended for everybody, but for the right investor who's held the property for enough time, this definitely could be an option. This may be a good exit point for you. That's number two. Number three, convert to a long-term rental, which is exactly what they want you to do. The challenge becomes, Patrick, is a lot of people are cash flow negative because they bought these properties at the height of the market, or they have recently refinanced at much higher interest rates. And as a result, converting to long-term creates cash flow negative for some people. So I will say two things, and I'll let you jump in for comments. Number one, that could be a short-term cash flow negative situation. May not be cash flow negative forever. And I think a lot of real estate investors kind of, what the situation is today, they assume it's going to be like that forever. Like for example, Patrick, 18 months ago, they were geniuses and they thought they'd be geniuses forever. And now today they're not, they're feeling like, oh man, these rates are higher. I'm not cash flow positive. That won't last forever because eventually you will refinance at a lower rate and you will bring up your cash flow. So that cash flow negative component of it does eventually go away, but it could be a little uncomfortable for a while, 6 months, 12 months, 18 months, 24 months, maybe more.
Well, I think there's a couple things around that. Yes, it could be uncomfortable. We were warning people back in, middle of 2022, I think it was, to make sure that you're not over leveraged and that you got some cash available, and ultimately what's happening if you bought 2-3 units, it's one thing to say, well, it could be negative cash flow for a while, but if you own 2-3-5 units, all of a sudden you're upside down several hundred or maybe a few $1,000s a month, a little bit tougher to carry. What is interesting about option number two that you gave, which was to sell, with interest rates, if they do, in fact, which we believe they will, if they do a hold, a pause next week.
Or a cut.
Yes, or a cut. It could, in fact, kind of spike the market. I don't want to say spike, but it could bring the market back to life a little bit in terms of buyers. Buyers like stability, and all the rates are still high. They're not going to go higher. We may see some buyers come into the market because that's the fear that some people operate on top of, which is these rates are going to go to 18%. They're still living into that old story of what was happening in the 80s. And so now that they've got a pause, we may see a little bit of a pickup, and you might be able to exit some of those properties if they're upside down.
Good. Next, another option, folks, is to bring in a joint venture partner. This, Patrick, we are actually in the middle of hosting a Raising Capital and Strategic Partnerships event. And folks, if you want to find out about that, you definitely got to get registered for that. We're doing information sessions on this. This is a course we offer at the Real Estate Investment Network. It's called Raising Capital. But this is a great idea, Patrick. Bringing in a joint venture partner. If you're going to be cash flow negative, you can bring in a JV partner to offset that cash flow negative component in exchange for some equity. And as a result, you don't have to be cash flow negative, and you could partially exit, but keep a partial upside of the future.
Yeah, that strategy is such a good one, especially if you're really upside down, you're feeling that pressure. You go, I can't afford the extra $500, $800 a month. What's interesting about it, if you've got a property that's got some equity in it, particularly you bring a joint venture partner in, if they can see the future, if you say to them, if the joint venture says, okay, I'll cover that $800 a month, and you look at it and you go, well, that's better than having to write a check for a down payment on a property. I'll spread my down payment, if you will, over, and I'll cover the $800 a month. Now you're breaking even. That's all great. And the joint venture partner has an equity stake in that property. So, it's just a way to structure the deal so that you can get from underneath the weight of carrying it and share in that particular property with the joint venture partner. It's a way for the joint venture partner to get in without scratching a big check for a down payment.
And there's a lot of people, and this is a brilliant idea, Patrick, because there's a lot of people out there that have good jobs, make good cash flow, and they even have the down payment, but they can't qualify for the financing. This is a fantastic way to bring in a JV partner who can easily afford this, but they can't qualify for financing. This property already has financing arranged. Great way to bring in a JV partner. And I'll go one step further, but I can't go too far on this because people are going to say, hey, tell me about that. Come to the information session, folks, on raising capital if you want to know more about this. But Patrick, this is a brilliant RTO, rent to own strategy, where you could bring in an RTO partner in order to cover that shortfall, in order to then exit that market, exit that property in a future market.
100%. And once again, this is all stepping back, taking a moment to plan, kind of take a breath, and then put a strategy together, put a plan together, and then execute on the plan, JG.
Another option, ladies and gentlemen, is go student rental. Okay, you could take your short-term rental, change the tactic, go student rental on it. Again, there's quite a few, let's call them barriers that have been introduced for student rentals. But student rentals cash flow better than long-term rentals. Do they cash flow as well as short-term rentals? I don't know about as well, but definitely better than long-term rentals. So some people transfer their short-term rental to a student rental. They still might be able to get at least to cash flow neutral, if not slightly cash flow positive. That's another good idea. And I'll finish with this, Patrick, and then you can comment is a lot of people, when we make these kinds of suggestions, that if you have 3 or 4 properties, your mind automatically goes to like all or nothing, meaning, okay, I'll transfer all of them to student rentals, or I'll go, long-term rental on all of them. This is not an all or nothing conversation, folks. If you have 2 or 3 or 4 or 5 or 10 properties that are all short-term rental and they're all at risk, you might decide, okay, I'm going to take 2 of them. I'm going to go student rental. I'm going to take 2 of them. I'm going to go cash flow. I'm going to go long-term rental. I'm going to take 1 of them. I'm going to do a JV deal, and I'm going to sell 1 of them. You could mix and match your strategy here in order to do the best thing for the entire portfolio. Instead of it looking at an individual property basis, look and consider the entire portfolio is where I'm going with this, Patrick.
Yeah, and I think, again, we have to look at the market that you're in. I mean, the number of international students that have come into Canada and the lack of housing for those international students definitely opens up opportunities if you're in the right market. So you have to look at what's going on in your market, whether it be colleges or universities, whatever those international students are coming in, they need housing. I mean, they're desperate for housing, for example, in Toronto, as one example. I think Victoria is another area where they're really strapped for housing for international students, for students in general. And so that really serves, there's a gap there that needs to be filled, and it is one option for investors to consider.
And if you want a good step forward in terms of figuring out, I wonder how the student population is doing in my particular city, because Patrick, you just named 2 big centers, but I got to tell you, go look at the colleges and you can actually get their enrollment statistics. Go look at their enrollments, see what's happened in 2021, 2022, 2023, and you're going to find out which centers need student housing. Because Peterborough, it wasn't on your list, Patrick, but let me tell you, people are starving for student rentals around here, and many, Barrie, Ontario, anywhere where there's a college where enrollment's up significantly, you're going to find a need for student rental there.
Well, and back to the headlines. That is the one headline that you're going to see in any given region because it's a huge topic, and so you can count on it. If you got a college or a university in your city, there's going to be controversy and lots of conversation about how international students can't find a place to live. They're living in the streets. They're living in bedrooms that are walled off with blankets. 7 people sharing one bathroom. There's all sorts of stories going on in different centers, but that will in fact be in the headlines. That'll be a good indicator for you if your region is in need of student housing.
So that covers short-term rentals, Patrick. I think there's some good advice there for investors on what they should do next and how they should take this seriously and how they can perhaps read, react, and adjust their tactic accordingly.
and not wait till May 1st, 2024. When everything kicks in on short-term rentals in British Columbia. Plan ahead. Be prepared. Plan
ahead. Hey, what's the saying, Patrick? I thought you were going to pull it out. It's definitely your kind of saying. What is it? Fail to plan or you plan to fail. Fail to plan and you plan to fail. That's a Patrick Francie 101 right there.
Well, that's not mine. I mean, that's old.
Well, that's why I said it's yours, because it's old.
Thanks, JT.
All right, ladies and gentlemen, hopefully you've enjoyed this episode 25. We covered the market statistics, the regionality, we covered the rents. We even made a Patrick prediction. In fact, we made 2 or 3 Patrick predictions. So we're going to find out if those come true. And we covered the short-term rental tumultuousness and what you should do about it as an investor. Thanks for tuning in, ladies and gentlemen. We'll see you on the next episode.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click there.